Hey folks, welcome to CFO Chat. As always, this is your platform, your front row seat with the Chief Finance Officer. Anytime a corporate action happens, there is nowhere it will be more exhaustively covered. Like here, we are privileged to have Yusuf Omari, ABSA, on their half-year numbers. Yusuf, karibu sana.
Thank you. Thank you so much.
And sorry for the flight, which you had to brace for this interview. Karibu, brother.
Thank you.
Congrats on the numbers. But Yusuf, I should start at this point. ABSA has always prided itself largely, in my own assessment, on its ability to tame its asset quality. For the first time in a long time, having covered ABSA for a while, I can see your NPL ratios in the double digits. What happened here? Did you have any notable downgrades? And precisely, was it a Q2 factor?
Yeah. No, thank you. And thank you for, again, for inviting me to this CFO chat. And as always, really looking forward to unpack the numbers. We released our results for half one today. And as we've seen our NPL ratios has gone. Now it's slightly above 11%. And consistently, we've always had single digits on this. Yeah. I think what we've noticed is twofold. One is a big impact going to the retail customers. So this is your personal household, category, who have been impacted as a result, of course, of a very high interest rate environment. We know what is happening in terms of government securities and the kind of returns you're getting there. And tied to that, of course, then the repricing that the entire industry has done in terms of lending. Tied to that, of course, is the issue of affordability concern coming from the retail side. They have been impacted because of course, the high interest rates. And we also know, taxes, for example, the housing levy is something that our customers had not planned for. And this one I'm talking about facilities that had been taken before, changes on the tax environment. So when we look at it holistically, our NPL has increased by about 7 billion during this time. And more than half of that is actually on the side of retail. The other component is sectors like manufacturing, we've seen, but these are name specific, so on the side of wholesale. And then we've also seen on the side of retail. Okay. So broadly, I'll look at those three sectors, manufacturing and the side of real estate that has impacted wholesale. Yeah. And then, of course, on the retail is a personal lending. But I must say, at a rate of 11%, still way better than the industry. The industry, nearly 17%. So still that element of quality of our asset is something that we are still holding in the industry.
No denying that, Yusuf. And I looked at your asset quality largely from a strategy standpoint. One of the things which has always stood out for ABSA Bank is the view that the 50-50 split between wholesale and retail gives you ability to navigate headwinds. For example, when you're now in the down cycle, your wholesale tends to give you a cushion there. Do you feel that in the credit risk environment we are in, maybe you should slash back on your appetite for retail and focus more on the wholesale side?
I think it's already happening indirectly because at the end of the day, the customers will be the ones to vote. We've seen a preference today for short-term facilities, and this really ties to the fact that it's expensive. Yeah. With high interest rates, customers are putting aside some of their big investments. Things like, for example, if you're on the side of manufacturing, if you want to expand your business or your factory, we are seeing customers postponing these at this point in time. And you see a very high appetite for working capital. Yeah. You want to be able to get financing for your raw materials. You want to get financing for your goods so that you can be able to sell. So if, for example, you're an importer. So big appetite, short-term facilities. We've seen overdrafts picking up significantly. We've seen trade, for example, off balance sheet. We are seeing letters of credit, guarantees, acceptances. Those numbers have actually increased significantly. And it just tells you right now the borrowing is more to do with business rather than for luxury, rather than, I'm borrowing to buy a car.
Yes.
So we've seen customers actually putting that, on hold during this time. On the retail side also, through our Timiza product, the 1 month facility, we are seeing that is also picking up very well. And then a product we've also launched with, a limit of over all the way to 1 million shillings, which is a short-term facility for 1 year. We are now starting to see our customers always also going for that as well.
I see. And how do you protect your margins given where the cost of funds are playing in this market? You've seen where the yields in the fixed income are. Something like an IFB infrastructure bond is giving 18% thereabout.
Yeah.
And I'm just wondering, especially when I look at your revenue split now, funded, non-funded, how do you protect your margins? Because clearly, not just ABSA, the entire industry, interest margins are really squeezed now.
Yeah. I think we've seen, because of the high interest rate environment, the cost of funds in the industry has basically gone up. At the moment, it's standing at around 6%. And this is simply because the customers who are holding deposits, including the wholesale deposit providers like fund managers, are actually demanding for a higher return, considering the alternative that they can be able to get: infrastructure bond, government security. And that has basically pushed the cost of funding. Now, the response to that is twofold. One is you are promoting products that have better returns. That becomes key. You're promoting products that have lower, risk scoring. So things to do with, for example, mortgage. You will not get someone defaulting on their own house.
Yes.
So that, if you look at our financials, that's an area that has picked up so well. Secured lending has also picked up as well. And then going for short-term. The short-term facilities have the highest margin. So if you look at, for example, credit card advances, the returns there are much better. So you are managing at a product level and making sure that even as you're growing on your net interest income, you're not, leaking on the side of impairment.
Yeah.
That has been the play that we've put during this period. But again, having said that, you'll always have ups and downs.
The cyclicality.
It's cyclical.
Yes.
Right now, the interest rates are up. A time will come when the rates will come down, and then, of course, we'll be able to help our customers.
But will they really, Yusuf? I know the CBK is now unwinding its tight monetary policy stance, but if you look at the fiscal side, and let's be honest, in this market we tend to have that fiscal dominance. GOK is increasingly going to the domestic market to plug the revenue holes. How soon do you see that coming?
I think, first, let me give credit. The monetary policies have really worked.
Especially on the inflation side.
Let's give credit where it's due. You've seen high interest rates, means you are containing inflation. We've contained, not contained actually, FX has significantly improved.
Oh, yeah.
There's a time to the dollar, the shilling was trading at 160. That has significantly come down. So we must recognize these efforts. GDP as well, you see it's picking up. Inflation now is contained, 4%. So that aspect has worked. The area that now the government is working on is fiscal policies. And this is how you raise your revenue. Could be through taxes, through, making sure that you don't have, revenue leakages. That is very key. And then on the other side is how you spend it. So how you, apply this revenue to areas which will be able to spur the economy. So that's the component that the government is working on. We know there's a lot of discussion happening, at the government level, and this is an area we're waiting to see.
Okay. Winding up our credit risk conversation. So how does your forward-looking provision look like? And I'm asking that because the market has been a bit volatile. You think you're done with the risks. Another crisis just emerges. How is your forward-looking positioning looking like?
We always take forward-looking provisions whenever there's significant movement in the key parameters that we are watching. The key parameters there will be interest rates. So every time the interest rates go up, we are taking forward-looking provisions. Yeah. So if you look at our impairment, while it's at the same level as last year, the loan loss ratio there is about 3.3%. That's high. We know that will start coming down as we go towards the end of the year, and we are starting to see better macroeconomic conditions in the country. But the minute you raise interest rates, we automatically take forward-looking provisions because we anticipate, defaults to come for the simple reason on issues to do with affordability. We take forward-looking provisions, looking at country ratings. We've looked at, for example, the downgrade for the country from the likes of Moody's. So that
recently
also,
S&P.
S&P as well. So that also pushes us to take forward-looking provisions. But again, it's also cyclical.
Yes, yes.
So we'll take these forward-looking provisions. When it improves, then we're able to release these provisions. I think one just good example, in foreign currency lending, 1 year ago we took some huge provisions. These are name specific, especially on the side of wholesale. The currency has strengthened. We are releasing that provision.
I see.
So I'm just using that as an example. For the forward-looking provisions, the same will happen. If the interest rate starts coming down, we see better ratings for the country, then our forward-looking provisions will definitely come down as well.
So Yusuf, please give us some color. When you talk about the developments around FX and how that allows you to release some of the provisions made, by way of a range, how much have you released so far?
I think if you look at our loans and advances, about 35% of that is in foreign currency. If then I look at provisions, they will follow. When you look at the loan loss ratios, you look at our NPL ratios, the same kind of ratios could be reflected on the side of provisioning. Anyone we've lent in foreign currency and we made provisions in the past, during this period, because of the strengthening, definitely we are releasing. Okay. So your guess is mine. You just need to work out at 160 exchange rate.
Yes.
To now at around 130.
Yeah.
The differential, the strengthening of that comes through provisions.
You're a witty guy, Yusuf. We've always had a conversation with ABSA, myself at least, and I've always asked about your loan to deposit in the 90s, and I've always been told we like to sweat our deposits. Here you are progressively ticking down now at 89.5%. Are you recalibrating your appetite or what's happening?
That's a very good question. And it will tie with my earlier comment on the proportion of our loans and advances between foreign currency and local currency. A year ago, 40% of our loans and advances was in foreign currency. We've seen quite a number of our customers moving away from foreign currency borrowing because of the volatility we experienced, especially last year, with a preference for local currency. We've seen customers who have actually converted their foreign currency facilities to local currency. What that basically has done is it's put pressure on local currency funding, the loan to deposit ratio. And for us, especially considering that we are an international bank, we have funding facilities in foreign currency, i.e. we don't rely on deposits only. We can always get funding coming from group to be able to finance foreign currency facilities, and hence the pressure that you've seen here on our loan to deposit ratio. So at the level that it is, 89–90%, that is still okay. If we see stability continuing on the foreign currency side, with the interest rate environment, we'll see now our customers again having an appetite to go for foreign currency, and to be able to take back our loan to deposit ratio to the level that it has always been, around 80%.
I see. I told you this conversation will be largely around your strategy because I think your numbers this time speak largely to your strategy in view of this environment. Cost to income. It looks like finally you are beginning to plateau off in the mid-30s, and I'm curious as to whether you're now going into an inflection point, because the last conversation we had, Yusuf, you did mention that your sweet spot would be somewhere in the early 40s thereabout, I think. Yeah. Are we now in an inflection going upwards?
Yeah, so I think we've seen significant improvement on our cost-to-income ratio over the period, and this is coming because of deliberate actions to automate, deliberate action to give our customers alternative channels. You heard today we are now launching agency banking, where now customers can be able to, to get their banking needs, not just from our traditional brick and mortar branches, but then of course from our partners as well. We've seen a big movement from branch kind of services to all these alternate channels, be it agency, be it points of sale, ATM, internet banking, and that has had a significant impact on the side of cost.
Yeah.
But then cost-to-income ratio is always a tale of two worlds.
Yes.
So revenue has consistently been picking. If you look at it, our market share has picked up over the period from about market share of about 7.5. Now we are above 9% in terms of market share. And that basically then means our cost-to-income ratio has improved. Having said that, we have big plans in terms of investments, especially on the side of digital, the digital world. That should be able to push our cost-to-income ratio to the low 40s. Yeah. And that's where we want to be.
Okay. Yeah. Yusuf, on the dividend. First of all, congratulations on the interim, but Yusuf, keeping it flat vis-a-vis HY23, my friend, your net earnings are up significantly. I don't think you have many peers in this market from an ROE perspective. Come on, man. What do you think about it?
Whenever we talk about dividend, there's one keyword I always put there. It's consistency. That's it. That's the most important bit when you're looking at dividend. You want to be consistent when you're declaring dividend. Interim dividend, we've been consistent. That has not changed. Yeah. But then when we come to once, of course, it's full year, the financials have been audited, you've always seen that we have been consistently increasing our payout. So I don't expect that to change if our financials, hold until the end of the year. And so changes, increases in dividend happens for full year, not for interim.
Yes.
But having said that, we've paid dividend in this industry consistently. It's only once during COVID that we did not declare dividend. And so our shareholders, this is a good stock. They look at the returns, and I'm sure they...
From a capital gain and dividend yield as well.
They're back home.
I see. Yusuf, from a revenue mix standpoint, and this is largely now a banking conversation, not just specific to ABSA, we are seeing increasingly non-funded income kind of taking a step back. And of course, the Forex line plays a significant role there. We sat not too far back and I asked you, what happens when the FX tide recedes? Because in the recent past, banks were making quite a kill there. Do you feel that now we have gotten to the point where it has receded to a point where it's not changing much beyond that?
Yeah, no, I think FX, we've seen stability this year. And if you look at the entire industry, the kind of margins that banks were enjoying on FX has significantly come down. We are not different. The margins has come down. And I think across the entire industry, if you look at the FX performance relative to 1 year ago, most of it is actually a drop. Now, it doesn't mean that the FX volumes have changed. Yes. If anything, for ourselves, FX volumes have actually increased. The thing that has happened there is just the margins have come down. Now, FX is not the only line we look at when you look at the non-funded income lines. In their banks, including ourselves, we are looking for new revenue streams. Today, when we release our results, I mentioned that all our subsidiaries are showing double-digit growth rates because of investment. And these are new, they're at infancy level. For example, we just started our custody business at the beginning of this year. We started our asset management 1 year ago. We started our securities business, also not too far. All these businesses are showing double-digit growth rates. It's just an issue of now their maturity. And so it's an investment that we are continuously doing to just make sure that then we can be able to grow the non-funded income lines. Yeah. But having said that, the other element, of course, is your customer numbers and customer primacy, i.e., how frequently are your customers doing their banking transactions with yourself? That's investment. That's the next area where we are doing investments, and hence my comment that digital becomes very, very key for us. Issues to do with partnerships, you'll see a lot of this happening. Let me not spill the beans at this point in time, but partnerships is very key. That will be able to grow that other line. So we are targeting to increase our customer numbers. We've seen that picking up, quarter on quarter, and this quarter is not any different. But that jump will come in once we sign the kind of partnerships that we're working at this point in time.
What shape and form are these partnerships taking? Yes, so are they partnerships skewed towards fintechs, as we are increasingly seeing banks do, or how are you designing them?
It's everything. So it's things to do with fintechs. Those ones are happening, but also partnerships with other organizations where we feel we can be able to sign up with them for financing for whatever goods they're selling. Those are areas that we are now signing up partnerships to just make sure then we are a first point of call to provide the financing bit while the different partners can be able to sell their goods and services.
Let's wrap up this conversation, Yusuf. The market regulator has indicated intentions to bump up the capital requirements in this industry. I'm just curious, thus far, I know it could be early days, what sort of conversations are you having as management at ABSA?
I think, number one, we are not impacted. We have significant capital way above
But you could
that.
be scouring locally.
Yeah. I think it's the right move to take, to be honest. It ensures that the industry is strong. It ensures that you have big players with financial muscles to be able to support that. And I always say this, if you look at the number of banks in Kenya compared to developed economies like South Africa, Nigeria, we have so many banks, if I was to put it that way. Now, if banks can be able to raise the whatever capital timelines that will be given, it makes the industry stronger. If that does not happen, then the opportunities for consolidation, the opportunities for M&A, and those are areas I'm sure the entire industry will be interested in.
Yusuf Omari, unfortunately, we have to close it at that point. We have been timed here. We have been speaking to Yusuf Omari, CFO, ABSA, following the release of the HY numbers. Stay tuned for more details on any other corporate actions happening.